In this lecture, we'll dip our toe in the arcane language of financial reporting. We're not going to become experts by any means. We just need to feel more comfortable watching the news and talking with financial professionals. Some investment guides advise you to learn how to analyze a corporation's financial statements. I disagree with that. The reason is that you'll probably spend a lot of time trying to learn stuff that won't help you with your investing. Let me explain. First, there's realistically no way that you'll get good enough at analyzing financial statements to do even rudimentary financial analysis. An old story involving the Schaefer Brewing Company illustrates the point. A professional analyst had spent countless hours studying Schaefer's financial statements. Finally, he reached a decision. He thought Schaefer was a good buy. His boss asked him if he'd investigated one single line of the multi-page financial statements, intangible assets. You may remember from Lecture 2 that intangible assets are things like brand names. I used the name Ferrari. No, said the analyst. He hadn't checked. Schaefer reported that it owned intangible assets of something like $20 million. Some of you may remember Schaefer's jingle. Schaefer is the one beer to have when you're having more than one. It turned out that Schaefer was claiming that that jingle was worth $20 million, which just seems silly. So the analyst changed his recommendation and they didn't buy Schaefer. Now, this was a high-level professional who'd spent hours analyzing Schaefer, and he didn't know to check this before making the decision to buy. Most people who tell this story think that the point is something like pay attention to details or check everything. That's good advice, but I think it misses the real point for people like us. The story might tell us something about the pitfalls of analysis, but it doesn't tell us anything about whether Schaefer was a good investment. Maybe the company was priced so low that it was a fair deal, despite the problem with the intangible asset. No, our goal is not to find good companies. Our goal is to find good investments. A company with lots of debt and declining sales might still be a good investment if the price is low enough. A great company with wonderful prospects might be a rotten investment if the price is high enough. Most people agreed that Apple was a great company in late September 2012. The disagreement was whether it was worth $700 per share. That great company, and it is a great company, was trading around $525 by November 2013. Yes, a great company was a horrible investment in September 2012. So why spend any time at all on financial statements? The answer is that we need to understand the language and concepts of financial reporting. When Jay Taparia, the founder of Sanskar Investments and Tax Services, was a visiting professor at the University of Illinois at Chicago, he wrote an article casting corporate financial statements in terms of our own more familiar personal finances. He suggested that we think of a corporate balance sheet as a mortgage application, a corporate income statement as being similar to our personal tax return, and the corporate cash flow statement as our checking account statement. Let's look at these three financial statements in a little more detail. If you've ever applied for a mortgage or other loan, then you have a pretty good idea of what a corporate balance sheet looks like. Your application was a snapshot of your financial position. On one section was a list of things you owned, and in another section was a list of things you owed. Lenders want to see whether or not you'll be in over your head if they give you the loan. A corporate balance sheet is a lot like that. It lists the company's assets, what it owns, on the left side, and its liabilities, what it owes, on the right side. I like to think of the balance sheet as the answer to the question that the company's owners and creditors always ask. What did you do with the money we gave you? Let's say somebody loaned the company $1 million and somebody else invested $3 million in the company's equity, an ownership claim. That's where the money came from. What did the company do with it? The answer might be, we still have $1 million in cash, and we used the other $3 million to buy a long-term asset, an office building. The right side of the balance sheet, the liability side, tells us where the company got the money. The left side, the asset side, tells us where it went. Every dollar that came into the company went somewhere, so the two sides of the balance sheet have the same bottom line. They balance. You need to realize that constructing a balance sheet requires making several assumptions. After all, the idea is to capture the essence of a huge company and distill it into information on a few pieces of paper, or today, a small computer file. Let's be blunt. That's an impossible task. You have to make simplifying assumptions, and you have to realize that the result is an estimate of reality, a guess, and not reality itself. That doesn't mean that the exercise of making financial statements is useless. Far from it. Financial statements can teach us a tremendous amount about a company. As with anything else, though, we can't expect them to provide more than is humanly possible. Let's look at some common entries on a balance sheet. You won't find all of the ones we'll discuss, and you'll find a whole lot that we won't discuss at all, especially for bigger companies. Even a relatively simple balance sheet takes 2 pages, and you're not going to earn a degree in finance and accounting from this lesson. Instead, we'll focus on a few key concepts so that we can understand the language that financial accountants use. The good news is that for the most part, accountants, financial economists, and other market participants didn't sit down to develop the language of finance and accounting. The language evolved, just like any other language. For example, what would people having a conversation call the cash that a corporation holds? They'd call it cash, and so would everybody else, because everybody understands what cash means. Sometimes the names aren't so obvious, but understanding a few concepts and applying a little common sense can help us get a feel for what the balance sheet is trying to tell us. For example, lots of times a balance sheet will have an entry like cash and equivalents and another called short-term investments. You may not know exactly what those equivalents are, but they have to be something that the company convert to cash immediately, even faster than a short-term investment. Those equivalents have to be something easily marketable, like treasury bills or maybe government bonds near maturity. You'd be right. The short-term investments would have to be a little less liquid than cash and equivalents, so we can guess that they're probably things like bank CDs. You'd be right again. The cutoff for short-term investments is 1 year. Anything lasting longer than that isn't short-term to an accountant. You know what inventories are, don't you? A company's inventory comprises the products on the shelf, goods in storage, and the like. For a company like AMD, which is a microprocessor company, the figure next to inventories would be the total value of the chipsets and other items that AMD has built but hasn't sold yet. Inventories can vary a lot during the year. Toy companies like Mattel tend to build lots of inventory before the Christmas and holiday season because so much of their sales are seasonal gifts. After Christmas, that inventory shrinks. It's a perfectly normal sales and inventory cycle. No company likes to have a lot of funds tied up in inventory because those funds aren't earning anything. Sure, you have to have inventory, but all else equal, I'd like to build a product on the exact day that a customer wants it. That way, I don't need to tie up money in inventory. That's impossible, of course. Inventory is a necessary evil for just about every company. For some, though, it's worse than for others. For example, if AMD has a lot of inventory, then that's really dangerous because the price of computer components tends to fall fairly quickly. $1 million worth of processors today might be worth half of that in just 6 months. That won't happen if Royal Dutch Shell has lots of unsold gasoline in inventory. Gasoline prices are as likely to go up as they are to go down. That's not so bad. If a company decides that some of its inventory has been damaged or spoiled or just become obsolete, then it'll take an inventory write-off charge. You'll sometimes hear that a company wrote down an asset. That means that management decided that the items are no longer worth their balance sheet values. As we work our way down the balance sheet, we'll eventually come to a line that reads total current assets. You know what that is. It's just the total of everything above it in the current assets section. The language of accounting tends to interpret current as meaning within the next year. So these are things the company owns that the company expects to convert to cash within the next 12 months. Moving farther down the balance sheet, still on the assets side, we'll find something like property, plant, and equipment. You understand this already, don't you? It's the value of all the company's property, plant, and equipment. That would be things like administrative structures, manufacturing facilities, tech equipment, land, stuff like that. Below property, plant, and equipment, you'll find a line labeled accumulated depreciation. That's tougher to figure, but given that it follows property, plant, and equipment, it probably has something to do with that property, plant, and equipment wearing out. Take this line with several grains of salt because accounting rules just can't handle all of the different ways that different things wear out, or more accurately, decline in value. Computer chips decline fast. The value of a building might even increase, especially if inflation is high. The end result is that assets are often worth quite a bit more or less than the balance sheet says they are. We don't have the time to go over much of the liability side of the balance sheet, and you'll find that you can reason your way through most of it yourself. Again, we're not trying to become certified public accountants today. We'll concentrate on the line that reads total stockholder equity, or perhaps total net worth. Total stockholder equity can change. One way is for owners to put more money in the firm. Another way is for the company to earn a profit and keep the money in the firm, usually by plowing it back into productive assets. You'll usually see the owner's contribution listed on a line named something like common stock. Remember, the liability side of the balance sheet keeps track of where the company got its funding. Sometimes you'll see a line labeled retained earnings. That's the money that the company earned and reinvested in the firm. That's why it's on the balance sheet liability side. It's a source of money. The retained earnings entry doesn't represent a pile of cash that can be tapped. If you want to see how much cash the company has, then look at the cash entry. Retained earnings are much more likely to have been invested in new productive assets like trucks and factories instead of being put into cash. The income statement is the second important corporate financial statement. It's the company's answer to the question, how much money did you make? If someone's looking for a company's report card, then he typically turns to the income statement. As I mentioned at the outset, Jay Taparia likens the income statement to your personal tax return. To oversimplify again, you list your sources of income at the top of your tax return, sales or revenues in the case of a company. Subtract your deductions like personal exemptions, business expenses for a company, and the result is your taxable income and income before taxes for the company. Notice that an income statement isn't a snapshot like a balance sheet. The balance sheet reflects a company's position at a specific point in time. A tax return or income statement spans a period of time, usually a year for a person, but often a quarter for a company. Like the balance sheet, the income statement requires accountants and analysts to make a lot of assumptions. For example, an income statement's figure for reported sales assumes that a certain amount of those sales will be returned and that a certain number of people won't pay for them at all. That assumption makes sense because returns and bad debts happen. But that doesn't mean that the number on the income statement isn't an estimate. Another reason income statements are estimates is that accounting procedures usually require land to be recorded at its cost. Over time, especially with inflation, the value of that land probably increases. That increase in value doesn't appear on the income statement. The first line on an income statement is usually either revenues or sales. Sales is the total proceeds from the sales of the company's products. Revenues include sales plus a few other sources of cash, such as payments received for royalties or patents. The next line is often cost of goods sold. Sometimes you'll just see cost of sales. This is exactly what you'd think it would be. Cost of goods sold is the direct cost of making the company's product, such as the salaries of the manufacturing employees, the cost of the steel, and the natural gas to produce the energy to run the factory. The difference between revenues or sales and the cost of sales is called gross profit. To get to net profit, we need to subtract indirect costs of producing the stuff we sold. Farther down the income statement, you'll find other expenses listed, and eventually you'll get to operating income. This is an important number because it's the profits that the company earned from its regular business during the reporting period. There may have been gains or losses from asset sales or restructuring charges and other non-recurring events, but operating profit represents what the company earned from its previous operations during the period covered. After those non-recurring items comes the provision for income taxes. If you're thinking of the corporate income statement as being similar to our personal tax returns, then this is the accountant's best guess of the amount that the government will take. What's left is net income, or the bottom line of the income statement. The cash flow statement is the third big financial statement that people use in evaluating a company's well-being, and as I noted earlier, it has been likened to your checking account statement. It's the bridge between the balance sheet and the income statement. Lots of analysts look at cash flow statements before anything else, and I can see why they might do that. If you decided to analyze your personal financial position, where would you start? Like most people, you probably start with your checking account. If you look a little more deeply at your checking account statement, you'll be able to tell where your money came from and where it went. There's a deposit for your salary and $100 from good old Uncle Pete for your birthday. You wrote a check to Lowe's for a new washing machine, have quite a few debits for gasoline, bought more groceries than you expected, and so on. That's the gist of the cash flow statement. It usually has three parts. First, there's cash flow from operating activities. This is the heart of the statement because it accounts for cash flows tracing to a company's business. For Carnival Corporation, this would be its operations as a cruise and vacation company, for example. The second component of the cash flow statement covers cash flow from corporate investing. You may have sold your old washer to the newlyweds down the street for $50, which you deposited in your account. Maybe Carnival raised some cash by selling a ship. Both you and Carnival had a cash inflow from selling an old asset you no longer need. Finally, the third component is cash flow from financing activities, like getting a loan or paying interest. That debit to Toyota Financial Services is the last one, and now that car is all yours. By comparison, Carnival may have paid off some maturing bonds. In both cases, cash went out the door to settle a debt. The idea behind the cash flow statement is to track the changes in a company's cash position. Given its name, that's no surprise, is it? To track those changes, accountants and analysts start with net income and then adjust it for things that affect net income but didn't affect cash. You might be asking, how can something affect income without affecting cash? Think of your car. When you bought it last year, it was worth, let's say $20,000. Now, though, it's a year older and has another 20,000 miles on it. Do you think you could still get $20,000 for it? Nah, potential buyers would see the extra wear and tear on it, and they'd cut their offering price. You might get $18,000, but not the $20,000 you paid for it last year. That $2,000 decline in value means that all else equal, you lost $2,000. But $2,000 didn't leave your pocket. An asset you owned wore out a little bit. It depreciated. Your income for the year is down $2,000, but your cash position didn't change because the car wore out. But you might object, I didn't sell my car, so I can't have income on it yet. Doesn't matter. Financial statements try to reflect reality, So you still need to account for your car's drop in value. You're not as well off as you would have been if your car's value hadn't declined. Notice that I used the word depreciated a few seconds ago. I did that on purpose because the first line of the cash flow statement after net income is often called depreciation. Depreciation expenses reduce income just like the depreciation on your car did, but they don't affect cash. On the cash flow statement, accountants add depreciation back into income to compensate. The same idea applies to corporate stock options when they're granted but not exercised. This usually appears in a line named something like share-based compensation. Stock options are a real cost to the company, so they have to be deducted from income, but they don't affect cash. You can find dozens of other lines on the cash flow statement, but let's skip them and get to net cash from operations. To get this, we just total net income and all of the adjustments. That gives us the net cash for the first of the three parts of the cash flow statement. The second part of the cash flow statement handles investing activities. These are investments at the firm level, such as building a new factory, as distinct from financing activities, such as issuing stock. You might see a line labeled additions to property, plant, and equipment, or maybe capital expenditures. Any item the company purchases for business that have a useful life over 1 year are considered capital expenditures. There may also be lines adjusting for acquisitions and divestitures, sometimes called just asset sales. Usually the last adjustment has a name like other investing activities to handle the things that aren't big enough to merit their own line. Add it all up and you'll get net cash from investing activities, which is the second of the three cash flow components. We won't take the time to go through the third component, financing activities. We'll just note that you'll find things like debt repayment, dividends paid, and proceeds from stock sales here. The result will be net cash from financing activities. After we add the three components of the cash flow statement, we get the net change in cash holdings. It's the total cash change in the company's balance sheet during the period. Although the world tends to focus on accounting profits, cash flow is what matters. You can calculate cash flow starting with net income and adding back depreciation and other non-cash expenses. Accountants will be the first to tell you that what they report as earnings doesn't really reflect the amount of money that the company produced for its shareholders. That's because, despite the accountant's best efforts, accounting earnings don't always reflect reality. My favorite example is the early years of FedEx. Federal Express initially had little or no profit because of huge depreciation charges from the cargo planes it had just put into service, so it had no taxable profits. It did have huge cash flow. The result was good stock price performance. So far, we've been discussing the levels on a company's financial statements, the absolute size of the numbers. That ignores the size of the company. What would be a lot of debt for a small bank like Citizens National with a couple of billions of dollars in assets would be just a smidgen for a behemoth like Bank of America with a couple of trillions of dollars in assets. Analysts calculate ratios to help handle size issues like that. For example, analysts get a feel for how much debt a company carries with the debt ratio. That's total debt divided by total assets. This can vary enormously from industry to industry. Bank of America's is in the area of 90% based on its balance sheet at the end of years 2010 through 2012. In contrast, Intel's debt ratio was much lower, ranging from 20% to 40% during the same period. Analysts can't agree on whether a firm should have a lot of debt or just a little because there are so many other factors involved. According to Forbes, Tiger Woods made over $100 million in the calendar year ending June 2010. With income like that, he can carry just a wee bit more debt than we can. Analysts do tend to agree that a rapid increase in debt is a bad thing, especially if comparable firms aren't showing a similar increase. You probably heard the old joke about a company that loses money on every sale. Somebody asked the manager how he expected to stay in business that way. He replied, "I'll make it up in volume." I'll forgive you if you didn't laugh, but I think you see the point. Without selling things for more than it costs to make them and get them to market, you just can't stay in business. That's why analysts check gross and net margins. Gross margin is gross profit divided by revenues or sometimes sales. This tells them how much of each dollar of sales is left to cover the costs running the rest of the company and go towards profits. Gross margins vary tremendously. Biogen's gross profit margin was around 85% each quarter from March 2012 through the first quarter of 2013. You can't sell a lot of oncology and immunology equipment, so you have to make a lot on the stuff that you do sell. In contrast, Kroger's gross margin was around 20%. You can sell a lot more groceries than you can expensive medical equipment, so you don't need to and can't demand a big profit margin in that business. Competition won't let you make that much. Just about everything we said about gross margin also applies to net margin. Net margin is net profit divided by revenues, or again, sometimes sales. Net margin is the part of each sales dollar that remains after we deduct those things we discussed earlier, like R&D and SG&A. You'll hear earnings per share, or EPS, mentioned a lot. You can guess what this is, right? It's the profit the company earned for each outstanding share of stock. You don't want to get too excited about a firm's EPS without more information. For example, if my shares are worth $2 each and I earn $1 per share, then that might be a big deal. If your shares have the same EPS of $1, but your shares are worth $200 each, then that doesn't sound like much. All else equal, though, a high EPS is better than a low one, and analysts like to see steady EPS growth from year to year. Let's do one more before we move on, the dividend yield. Perhaps you'll hear that a stock is yielding 3%. That means that the company pays dividends at a rate of 3% of its stock price. For example, if a stock pays out $3 in dividends over the course of a year and trades at $100, then its dividend yield is 3%. A high dividend yield tells me more about the nature of the company's growth than it does about whether it's a good deal or not. Mature companies tend to have higher dividend yields because they don't have a lot of growth opportunities and therefore aren't reinvesting their profits in new ventures. That's what mature means. They pay out all their earnings in dividends instead. A growth company needs to plow its earnings back into the company to take advantage of those growth opportunities. Lots of companies don't pay any dividends at all. Some of those are growth companies, and some are companies that have fallen on hard times. You'll notice that I haven't recommended that you spend a lot of time studying financial statements and reports. Let's face it, those are tedious and dreadfully dull. There's one exception. Go to eBay and find a copy of one of Marvel's annual reports from the 1990s through 2006. During that time, Marvel Comics had the wonderful policy of having their superheroes present the company's financial data. In 1991, the cover featured the colorful cast including Spider-Man, Captain America, the Incredible Hulk, of course, and others assembled in front of the New York Stock Exchange. How cool is that? The next time you watch the news or read an article about a company, listen for some of the terms we've heard today. You'll also pay attention to words and concepts that we didn't discuss today. Armed with knowledge from today, you'll probably be able to have at least some idea of what these unfamiliar terms mean. You're in a position to keep learning on your own. That's super. In our next lecture, we'll study the very inexact science of corporate analysis and valuation. We won't try to become experts in that either. No, the reason we want to learn about valuation is that by understanding what drives corporate value, we'll understand why businesses make some of the decisions that they do. That's always helpful.